Today we're looking at a really detailed analysis report. Blackwell is coming, why NVIDIA will crush 2026 estimates.
Yeah, and the core argument is that with Blackwell's ramp-up, plus this huge demand from sovereign AI and inference, the current revenue estimates for 2026 are just way too low.
The conviction here is, it's really impressive. The research is deep. But to get this piece to its maximum impact, we need to think about the pushback it's going to get.
Exactly. The really tough questions that a skeptical investor is absolutely going to ask.
And that brings us right to our first piece of feedback. To elevate the analysis from a strong bull case to a truly authoritative investment thesis, the report has to incorporate and then strategically dismantle potential counterarguments and risks.
Yeah, it's all about robustness. Right now, the piece focuses almost entirely on the tailwinds.
It does. You see the Blackwell performance delta, that 2.5x to a 4x number.
The mid 70% gross margins, the $22 billion in free cash flow per quarter. It's all incredibly positive.
But there's no real discussion of the headwinds. And a sophisticated reader might see that and think the writers may be deliberately avoiding the tough spots. It could undermine the objectivity.
Well, and it's clear the writer knows their stuff. This isn't about them not knowing the risks.
Right. It's about acknowledging them, showing you've thought about them, and then just neutralizing them head on.
So our suggestion here is to integrate a dedicated, brief section. You explicitly call out the main risks to the Blackwell ramp and that 2026 forecast.
And this is the key part, you do it only to show how NVIDIA's position already mitigates those exact risks.
You're building confidence by tackling the skepticism directly.
So how would you frame that? How do you do it without, accidentally weakening your own argument by highlighting doubt?
You have to be aggressive with it. For example, you bring up the possibility of manufacturing bottlenecks or like Blackwell's supply chain delays.
Which always happens with these big, complex chip launches.
Always. But then you immediately pivot and use the report's own data. You reference the fact that industry reports show Blackwell's supply is already spoken for through the next 12 months.
Ah, okay. So the evidence of this massive pre-booked demand actually becomes the answer to the supply risk?
Exactly. You turn a potential weakness, the risk of not meeting demand, into a massive strength. It proves this incredible demand visibility for the 2026 forecast. It's almost a certainty.
That's a very sharp way to handle it. What about competition?
The other big one. You have to mention the competitive pressure from hyperscalers building their own in-house chips. That's a classic bear argument.
Right.
But again, the piece already has the perfect counter. You just need to weaponize it. The report talks about the Blackwell B200's huge economic efficiency advantage over the H100 or H200.
Can you break that down? What does economic efficiency mean in simple terms here that really forces an upgrade?
It's the total cost of ownership. We're talking about a massive reduction in power consumption, in physical footprint, and the operational cost per unit of AI compute, per petaflop.
Okay.
So if a competitor's chip is even a little less efficient, the cost for a hyperscaler running, billions of users 24/7, it just becomes economically impossible at scale.
So the writer can use that to basically dismiss the in-house chips as a near-term threat to the 2026 numbers.
Precisely. You frame them as economically obsolete for the kind of scale we're talking about over the next 12 to 18 months. By addressing the risks like that, the final conclusion just feels so much more earned.
I think that's excellent advice. It really builds credibility. Okay, let's move on to our second critique. The structural flow of the report, we feel it could be refined to make it even more impactful.
Yeah, to create a more logical progression, specifically distinguishing between the short-term catalyst and the really big long-term demand drivers.
The structure is clear now, but the way it's sequenced could, I think, accidentally undermine the main thesis about crushing estimates.
It moves a bit too fast from the Blackwell supply shock, which is the immediate tech and pricing catalyst, straight into sovereign AI and the inference explosion.
And those are the huge, multi-year structural demand pillars.
Right. And that quick jump, it kind of blurs the lines. Is NVIDIA just filling existing demand with a better chip, or are these pillars creating new, totally unanticipated growth?
Which is what you need if you're going to crush a consensus that's already as high as $272 billion.
Exactly. So the suggestion is to resequence the sections. Establish a clear hierarchy.
How so?
You position the long-term, structurally underestimated demand, sovereign AI and inference, as the reason why Blackwell is guaranteed to be sold out at these crazy high margins.
So you put the foundational why, the huge market shift, before you introduce the what, which is the new chip that solves for it.
Yes. It reinforces the whole thesis that the current estimates just have to be too low.
What would that look like in practice?
I think you could create an explicit section, maybe label sovereign AI and the inference shift as the structural multipliers. Something that signals these things are fundamentally changing the total addressable market, the TAM.
Right, right. Let's focus on sovereign AI for a second. For anyone not deep in this space, why is a nation buying chips so different from a Microsoft or a Google buying them?
It's a totally different driver. This isn't just an enterprise buying cloud credits, it's a matter of geopolitical necessity.
Okay.
And the report has great detail on this. It talks about Japan, France, various Middle Eastern states. They're all demanding the absolute latest hardware, and they're not sensitive to price.
Because it's about national security, data sovereignty, defense.
Exactly. It's driven by government mandates, not quarterly IT budgets. So in terms of structure,
Where does that argument go?
it needs to be positioned before the deep dive into Blackwell's pricing power. First, you show the reader who is paying these incredible prices. Governments with deep pockets. It proves the demand is inelastic. It's a completely new, high-margin growth engine that Wall Street probably isn't modeling correctly.
That makes perfect sense. It establishes the cause and effect. Okay, what about the inference explosion part?
That needs a similar tightening. The writer has to explicitly connect the long-term trend, which is, billions of users running AI 24/7.
The need for massive scale and lower costs.
Right. Connect that directly to the economic mandate that forces hyperscalers to upgrade the Blackwell now.
So you move the argument from just inference needs better chips, which is strong,
To something much more forceful. Inference at scale is economically and operationally impossible without the B200's specific efficiencies.
which forces every hyperscaler to accelerate their Blackwell transition no matter what their short-term CapEx plans were.
Yes. It shows the upgrade cycle is a structural necessity, not just a choice. It moves the whole argument from NVIDIA is better to NVIDIA is now structurally mandatory.
Love that. Okay, let's get to our third and final critique. This one is about maximizing the financial firepower in the analysis.
Yeah, this is a huge opportunity. The report introduces some really powerful financial metrics, especially the valuation ratios, but it doesn't quite weaponize them.
Right. It doesn't use them to directly and mathematically challenge the Wall Street consensus.
It's so close. The report states that the stock is trading at roughly 33x fiscal 27 earnings and that the PEG ratio is around 0.5 to 0.7.
Which for a company with over 60% revenue growth suggests it's seriously undervalued.
Exactly. But that's where the observation stops. It feels disconnected from the main revenue thesis. It's an interesting valuation note, but it needs to do more than just say the stock is cheap.
It needs to use those numbers to prove the consensus revenue estimates have to be wrong.
Yes. So the suggestion is to use that PEG ratio discrepancy as a quantitative tool. You can actually reverse engineer the numbers.
And calculate the required revenue floor you'd need to justify those target prices. The $225 base case, the $250 to $300 bull case.
And suddenly, you have a mathematical proof that the consensus ceiling of $272 billion is structurally impossible under the report's own assumptions.
Okay, I really like the mathematical angle, but here's a potential pushback. Couldn't the skeptic just say that's a circular argument? That you're just assuming the market will accept the growth rate needed for a 1.0 peg?
That's a great point, and it's a challenge you have to address preemptively.
How?
The report can counter that by framing it as a market mispricing right now. Pose a direct question to the reader. Something like, if we agree the market will accept a conservative high-growth PEG ratio of 1.0, what revenue figure is mathematically required in FY27 to avoid the stock being fundamentally mispriced today?
And that calculation would almost certainly spit out a number much higher than $272 billion.
Instantly. It makes the consensus look negligent, mathematically speaking. You're shifting the conversation from a qualitative, NVIDIA's growing fast, to a quantitative, the market's math is wrong. A step further. Use that 33 by FY27 earnings multiple as your baseline. The writer can show that the implied growth rate baked into that $205 to $272 billion consensus range is actually much, much lower than the 60% plus the report establishes.
So you show what the consensus is implying.
Exactly. You reveal the slow growth rate that's hidden inside the consensus numbers, and it just looks absurd next to the operational data. It mathematically confirms why $272 billion has to be seen as a floor, not a ceiling.
That's brilliant. It turns the valuation metric into a weapon against the consensus narrative. It offers quantitative proof for the entire thesis.
And it creates this perfect, seamless loop.
It links the financial metrics right back to the core drivers, sovereign AI and inference, and it achieves a sense of certainty where others are just speculating.
This has been an incredibly insightful discussion. I mean, the foundation of this analysis report is just so strong. These adjustments will really help it achieve its maximum potential.
Absolutely. It's a great piece of work.
So, to quickly summarize the actionable suggestions here. First, integrate that proactive risk discussion.
Yep. Bring up supply chain constraints or competition, but only to immediately neutralize them with the data on demand visibility and the B200's economic edge.
Second, reorganize the structural flow. You want to clearly establish the relationship between the Blackwell catalyst and those long-term demand multipliers, sovereign AI and inference.
Put the long-term necessity before the short-term tech advantage. It makes the crush estimates thesis feel inevitable.
And finally, maximize the specificity of that valuation argument. Fully leverage the PEG ratio to reverse engineer the revenue floor required to justify those price targets.
Use math to prove why that $272 billion number should be the absolute minimum, not the maximum.
It's an aggressive, quantitative challenge to the current consensus. We are very keen to see how the revised report locks in that certainty.
I am as well.
We absolutely encourage the listener to make those revisions and submit their analysis report back for a follow-up critique. Until next time, keep refining your work.